Trend lines and moving averages represent dynamic levels of support and resistance. Chapter 6 points out that a good trend line should reflect the underlying trend. One of the rules for assessing the significance of a line relates to how many times it has been touched or approached. The more, the merrier in this case. If a price falls back to a specific low on several occasions, this makes that particular price level a strong support zone. The same is true of trend lines and moving averages. Every time a price moves back to an uptrend line on a rising moving average and bounces, it is reinforced as a dynamic level of support. Every time a price every time a price moves back to an uptrend line or a rising moving average and bounces, it is reinforced as a dynamic level of support. The same would be true in reverse for declining trend line or moving average. Therefore, it makes sense to buy as the price falls to an uptrend line or rising moving average, and to sell when it rises to a downtrend line or falling moving average. Therefore, it makes sense to buy as the price falls to an uptrend line or rising moving average, and to sell when it rises to a downtrend line or falling moving average. A low risk stop may then be placed A low risk stop may then be placed just beyond the line or moving average in case of the support or resistance zone is violated. A low risk stop may then be placed just beyond the line or moving average in case the support resistance zone is violated. Chart 5.2 shows a very good example of how a downtrend line acted as resistance for Hewlett-Packard. Note also that the interaction of a reliable moving average, such as the 200-day moving average featured in this chart, acts as a reinforcement of the resistance zone. Chart 5.2 Hewlett-Packard Daily 200-day moving average. Intersection of good trend line and reliable moving average is equal to massive potential support or resistance. Source Martin Pring's weekly info movie report. This works in the same way as if we were building a house and doubled the thickness of the roof. The identical principle holds when a moving average and trend line are at the same level. They double the strength of resistance or support in the case of an uptrend line and moving average intersection. Emotional points on a chart represent potential support resistance levels. This concept will be covered in subsequent chapters when we consider gaps, extreme points of Pinocchio bars, 2 bar reversals, key reversals, and so forth. For the moment, suffice it to say that most emotional points are those at which a price, following a persistent trend, experiences a strong extension of that trend. During the course of the bar's formation, it then abruptly reverses direction. It is the abruptness of the reversal that is the key, since it tells us, depending on the direction, that either buyers or sellers are exhausted. When the point in the chart is again revisited, it often forms a barrier to further progress. In other words, a support or resistance level. Gaps represent another example of emotional points. They are formed when buyers or sellers respond so emotionally to the news that a blank rally find resistance at gap opening. When that point, okay. Later on, when emotions become more stable, the price rallies and tries to close each of the gaps. In the case of the gap on the left, resistance is found at its opening. In the other two examples, the resistance forms at the lower part of the gap. Gaps are one of the most reliable technical concepts from the point of view of projecting potential support or resistance areas. We see some good examples in 2011 for the market vectors coal exchange traded fund chart 5.4, where the small rectangles highlight the gaps and the horizontal lines represent the high and the low for the gap with their obvious support implications. Chart 5.5 shows another emotional point for Boeing. This time it's the bottom of a very wide bar in early 2002. Note that this low developed at round number $50. Normally, this would have been a support level the next time the price fell to $50, but in the fall of 2002, the price went right through it. Even so, $50 did turn out to be a pivotal point the next time Boeing rallied. It goes to show that even if a support or resistance zone is violated once, it can still turn out to be a pivotal point in the subsequent price action. Chart 5.4 Market Vectors Coal ETF KOL Market Vectors Coal ETF KOL. The law of motion states that for every action there is a reaction. Price trends established in financial markets are really the measurement of crowd psychology in motion and are also subject to this law. These swings in sentiment often show up in proportionate price moves. Perhaps the best known principle of proportion is the 50% rule. For instance, many bear markets, as measured by the Dow Jones Industrial Average, have cut prices by half. As examples, the 1901 to 1903, 1907, 1919 to 1921, and 1937 to 1938 bear markets recorded declines of 46, 49, 47, 50% respectively. The first leg of the 1929 to 1932 bear market ended in October 1929 at 195, just over half the September high. The halfway mark in an advance sometimes represent the point of balance, often giving a clue to the ultimate extent of the move in question or alternatively indicating an important juncture point for the return move. Thus, between 1970 and 73, the Dow advanced from 628 to 1067. The halfway point in that rise was 848, or approximately the same level at which the first stage of 1973-74 bear market ended. Wow. Chart 5.5 Boeing Weekly emotional point. By the same token, rising markets often find resistance after doubling from a low. By the same token, rising markets often find resistance after doubling from a low. The first rally from 40 to 81 in 1932-37 bull market was a double. In effect, the 50% mark falls in the middle of the one-third to two-third retracement described in Chapter 2 in the discussion of peak and trough progression. These one-third and two-third proportions can be widely observed in all securities and also serve as support or resistance zones. Ratio scale charts are helpful in determining such points since moves of identical proportion can easily be projected up and down. Moreover, these swings occur with sufficient consistency to offer possible reversal points at both peak and troughs. Remember, technical analysis deals with probabilities, which means that forecasts should not be made using this method in isolation. Ratio scale charts are helpful in determining such points since moves of identical proportion can easily be projected up and down. Moreover, these swings occur with sufficient consistency to offer possible reversal points at both peaks and troughs. Remember, technical analysis deals with probabilities, which means that forecasts should not be made using this method in isolation. In addition, when undertaking a projection based on the rules of proportion, it is always a good idea to see whether the price objective corresponds to a previous support or resistance point. If it does, the odds are much higher than this zone will represent a reversal point or at least a temporary barrier. When a security price is reaching new all time high ground, another possibility is to try to extend up trend lines. The point at which the line intersects with the projection using the rules of proportion may well represent the time and place of an important reversal. Experimentation will show that each security has a character of its own, with some lending themselves more readily to this approach and others not at all. Chart 5.6 shows an example using one third, two thirds, and 50% retracements for the Power Shares Dynamic Insurance ETF. In this instance, the decline from 100% line to the 0% line A is 100% of the move. If we want to establish possible resistance points for subsequent rebounds, then the intelligent places to monitor are these one third, two thirds, and 50% retracements. As you can see, the rally ending at B, C, and D represent a 33%, 50%, 66% of or two-third retracement respectively. These pivot levels remain in force once surpassed. You can see this from the decline at E, which was halted at 33% mark. While we do not know ahead of time when these retracements will halt at one third, 50%, or two-third pivotal points, we can certainly get some clues by examining some of the other technical indicators as the price approaches these junctures to see if things are in fact consistent with a turn. Many technicians use a sequence of numbers discovered by Leonardo Fibonacci, a 13th century Italian mathematician. The sequence has many properties, but a key one is that each new number is a sum of the two previous numbers in the series. Thus, 5 and 8 equals to 13, 8 and 13 equals to 21, and so on. The significance of this sequence for our purposes is that it offers some guidance for proportionate moves. For example, each number in the sequence is 61.8% of the next number, 38.2% of the number after that, and so on. In this respect, charts 5.7 and 5.8 show some possibilities for the silver ETF. The retracement moves are measured in exactly the same way as in the previous chart, except that Fibonacci numbers have been substituted. In the case of chart 5.7, the initial rally was halted at 23.6% level, the next at 50%, and the third move up at level just shy of 61.8% of the March to September 2008 decline. We can also see that an advance was held at the 50% mark at E and at 61.8% level either side of F. In chart 5.8, we see how the 38.25 level comes into play a couple of times and the value of gap opening as two rallies were turned back at B and later at D. Note this very same level was reinforced as a pivotal point not only because of its importance as a gap opening but also a 38.2% retracement level as we can see at D. Finally, previous lows as a support generating principle came into their own at C. Chart 5.9 shows the same principle applied to upside projections. Once again, AB represents 100% of the decline and lines are drawn at upside Fibonacci proportions. In this case, the next higher number divided by the current number is 1.61, then 2.61, and so on. It is self-evident how the 161.8% and 261.8% proportions become key pivotal points in future price action. Once again, these levels are not guaranteed to become important pivotal points but are intelligent places on the chart to anticipate the possibility.